It's not about making rich or playing the market when you invest. In order to achieve financial well-being, it is crucial. That is being able to take care of your own needs as well as the needs of those who depend on you. It also entails setting and achieving goals that go beyond only being able to handle debts like credit card, mortgage, and student loan payments. These 10 steps can help you increase your investing success and achieve financial wellness, even when financial markets seem unfriendly. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Start with a plan. We think putting together a financial plan can serve as the basis for successful investing. The process of financial planning can assist you in assessing your situation, defining your objectives, and coming up with a plan of action to reach those objectives. Planning your finances doesn't have to be difficult or expensive. You can accomplish that with the aid of a financial expert. Making a strategy based on strong financial planning principles is a crucial step in either case. One service that financial advisors commonly provide to their clients is a plan. There is some proof that families who work with financial advisors are more capable of achieving the long-term financial objectives. A family that worked with an advisor had a median retirement score of 89, higher than the score of 81 for families who did not seek the assistance of an advisor. According to the Retirement Savings Assessment, which examined thousands of American families to determine how prepared they are for retirement. Of course, a higher score for an advisor could be attributable to additional services the advisor provided or unique characteristics of the families who sought out their advice. Number 2. Stick with your plan, even when markets look unfriendly. It's only natural to feel the need to seek safety when the value of your investments decreases. The best investors, though, don't. Instead, they continue to own a portion of equities that they can tolerate in both good and poor markets. It might have appeared wise to seek shelter in cash during the financial crisis of late 2008 and early 2009, when stocks fell by about 50%. Those who stayed invested saw their account balances, which reflected the impact of their investment choices and contributions, grow 147% in the decade after the onset of the crisis in June 2008. For investors who left the stock market in the fourth quarter of 2008 or the first quarter of 2009, the average return was 74%. While the majority of investors remained unchanged during the market slump, those who did made a crucial choice that had a long-lasting effect. More than 25% of stockholders who sold their holdings never returned to the market, missing the ensuing gains. If you experience anxiety when the stock market declines, keep in mind that this is a typical reaction to volatility. Maintaining your long-term investment mix and having sufficient growth potential can help you reach your objectives. Consider a less volatile investment mix if you find that you cannot handle the ups and downs of your portfolio. Number 3. Be a saver, not a spender. While it's simple to get swept up in the market's ups and downs, it's equally crucial to consider how much of your income you are setting aside for the future. Making progress toward long-term financial goals can be aided by early and frequent savings. We generally advise saving at least 15% of your income, including any employer match, for retirement. Naturally, that figure is only a starting point. For some people, it will be lower, and for others, it will be higher. Nevertheless, there is proof that increasing savings and starting earlier can help people achieve long-term objectives. Dedicated savers, or people who contributed more than 10% of their salary to retirement savings, earned a retirement score of 99, according to the Retirement Savings Assessment. The median score, on the other hand, was 68 for those who saved less than 10%. All committed savers scored better on average, but the disparities were greatest among younger savers who had more time to accumulate savings during their careers. Number 4. Be diverse. We feel that diversification, which may assist manage risk, is a crucial component of successful investing. It could be simpler to continue with your strategy during market ups and downs if you have a proper investment mix, giving you a portfolio that offers growth potential with a level of risk that makes sense for your position. Diversification aims to offer a fair trade-off between risk and reward, but it cannot ensure profits or prevent losses. You can diversify both between stocks, bonds, and cash as well as within each of those subcategories. Think about varying the size, investment style, sector, and geographic exposure of your stock exposure. Consider spreading your bond portfolio over a range of credit ratings, maturities, and issuers. According to the Retirement Savings Assessment, investors whose asset allocation is on track appear to be more prepared for retirement. The median score for those who were on track was 87, while the score for those whose investment mix was off track was just 77. Number 5. Consider low-fee investment products that offer good value. Although they can't control the market, astute investors are aware that they can control costs. Funds with lower expense ratios have historically had a higher probability of outperforming other funds in their category, in terms of relative total return and future risk-adjusted return ratings, despite the fact that this is by no means a guarantee, according to a study by independent research company Morningstar. The cost of trading has an impact on your returns, and we discovered that trading commissions and execution differ significantly among brokers. Find out more about exchanging savings utilizing price improvement. Number 6. Don't forget about taxes. Keeping an eye on taxes and account kinds is another habit that could aid in the success of investors. Higher after-tax returns may be produced via tax-advantaged accounts like 401ks, IRAs, and particular annuities. The quantity of money you put into various types of accounts should be determined by the tax treatment of each account. This is what investors refer to as account location, the practice of placing different sorts of investments in different types of accounts. Depending on the tax efficiency of the investment and the tax treatment of the type of account, is known as asset location, and it is a related idea. Although taxes shouldn't ever be the sole factor influencing your investing choices, you might want to think about placing your least tax-efficient investments in tax-deferred accounts like 401ks and IRAs. In the meantime, taxable accounts are typically a better fit for investments that are more tax-efficient. Number 7. Pen down your goals. New investors typically have objectives like purchasing a home, a car, traveling, pleasures, etc. The choice of where to invest money and the timing of when you will need it are both aided by the identification of your goals. For instance, you can choose a mix of equity and fixed investments if you want to buy a property in 5 years. Additionally, you can invest in liquid mutual funds or fixed income securities if you plan to travel within the next 6 months. Investments in equity may not be helpful in this situation because a sharp decline in the index could wipe out your principal. As a result, setting up a plan and writing down your objectives are crucial if you want to be a successful investor. Number 8. Don't put all your eggs in one basket. Investment diversification is a time-tested principle that still helps investors succeed today. A young investor's portfolio should include both stable investments that serve as a buffer against market swings and risky ventures. Fixed assets are safer and will shield you from significant market changes. By investing in shares, mutual funds, index funds, or bullion, you can diversify your portfolio across a range of industries, like the auto, banking, information technology, etc. When making risky investments, all successful investors must abide by a set of unbreakable principles. Number 9. Persistent and disciplined approach. Rome was not created in a day, as you must be aware. Similar to how you build your savings account, your investment portfolio is grown via disciplined investing and consistent saving. Young investors frequently have a propensity to overspend or just delay making investing decisions, leaving their money sitting in bank accounts. This strategy keeps you from developing into a successful investor. Number 10. Keep track of investments. Making investments is only the beginning of your efforts. You must closely monitor and watch your investments, just like you would a plant that you are watching develop, tending to it and pulling weeds. Successful investors are aware that some investments result in losses or don't increase in value. They don't think twice about selling their investments and reinvesting the proceeds in more promising ones. This is it for today's video. Which of the money habit do you like most? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.